Okay, in this quick video, I want to give an update on following investor flows. And I shouldn't say investor flows. I should say following what I am claiming are Wall Street flows in and out of leverage products via creations and redemptions of leverage traded products. So 2 weeks ago, I made this post and I'm just going to read it. You can search it in my tweets if you'd like. It says, probably worth reading the below. For those who don't follow my work, the chart below shows the amount of money investors, in quotation marks, have made, meaning Wall Street has lost on net by investing in 49 of the largest leverage exchange traded funds year to date. For context, since inception, these products have generated over 200 billion in cumulative investor losses. So we're getting close to 20-year time period when the first ones came out. If the current trend holds, this would be only the second year in which LATF investors collectively made money at Wall Street's expense. And yes, LATF shares are liabilities on issuer and swap counterparties' balance sheets. I hope that makes sense to everybody. If it doesn't, it's a factual statement. LATFs hold either entirely for the inverse products or for the leverage portion, the performance portion of the 3x longs, 2x longs, swap contracts. Swap contracts, in simplistic terms, are IOUs between large Wall Street institutions. My factual and honest take, short-term extreme paper losses, paper meaning temporary and not real, for Wall Street have happened before, but historically they have been relatively short-lived. This is not different. In my opinion, this is a harbinger of a major pullback during the rest of the year. You don't have to pay attention now, but search my tweets for the phrase, quote unquote, won't be wrong. You may be surprised. And then I say I won't be wrong again. Important note, this is not the same as a day late, dollar richer. If you have a question on that, I wrote a paper. It's in a book. The paper's free, basically saying that you can follow along with the issuance or redemptions, the creations or redemptions of these products. When the issuer creates products, they are selling it to the market. Therefore, you should sell or sell short. When there are redemptions, they are buying back. So you should buy to cover or buy the product. And if you follow those along with these 49 products, I say your return following share for share or a scaled version. And I recommend where I point out a scale of 1 to 100,000, you're following 1/100,000th of what the issuers do. You'd be up over 100% year to date. That is a factual, true statement, and it is auditable and you can validate it. It's going to take you some time, but it's a true statement. So take my word, or you can prove it yourself, or if you like, try to disprove it. How you bet in line with the DLDR this year on these same 49 tickers, the model would be up over 100%. True statement. It behooves you to test my work. Financially, it behooves you. Learning, it behooves you. In every possible incentive structure, I believe it would be to your benefit, specifically the small trader, the small investor, and on a maximum loss or portfolio exposure viewpoint, the larger your account is, the more money you have at stake. And you are not choosing to buy these, by the way. The vast majority of these are held in some type of managed product or managed account, meaning there's a fiduciary in between you and the issuer making the decisions on your behalf. They're gambling with your money for their benefit, not for yours. The below is free on the FRAWD Research homepage. It is absolutely free. You could check it every day if you'd like to. And then I show a screenshot of the homepage from the dates year to date at the time from 1/1/2026 to the end of day 6/2/2026, showing that $47.5 billion was made in these products, meaning that Wall Street is on the liability side of that other side. They were giving the leverage factor, meaning investors, for every dollar invested, every dollar of exposure, the aggregate amount of money, I call them patsies because the long term, this clock will turn red, has made year to date versus what Wall Street has. So just want to provide an update now. So we'll go to the web page. This is the home page, not logged in, completely free. We're going to change the date here so you can see the number matches. We're just going to go to the current date, hit refresh, and see what money the house has lost in addition to what they had, or money they have clawed back. And once again, this is following the issuance, share creations, and redemptions. So it's crunching a lot of data there. It's going to take a minute to upload. So 2 weeks later, or roughly 2 weeks later, Wall Street now has only lost $36 billion. I encourage everyone to watch this more over time. As I made a statement, won't be wrong. I think this number turns red before the end of the year, meaning that Wall Street makes back not only $36 billion, but much more. And I'll just add some more color. There's a drop down here with the 49 tickers that are being used. Some of these are quite large, SOXL and TQQQ. both have current net assets in excess of 35 billion each, which means for that to turn red, those need to stop going up at some point. And if they turn negative sharply, that number of 36 billion benefit for investors thus far this year could very quickly and easily turn to 20, $30 billion of net losses before year end. So you don't have to believe me now. I'm making a call, keep it in the back of your mind. You can check this back daily and you can see it over time. So hope that's of your benefit.